Hey guys, welcome back. Today's topic is fourth quarter results of Netflix. We will go through their financial performance, we will go through their number of new subscribers, we will go through their future plans, how are they going to compete with their a lot of new competitors which are coming and aiming for number one spot in streaming world. We will check how does their balance sheet look like. I will even give you my opinion about price of a stock or company right now. We will also speak broadly about streaming sector. How is Netflix doing right there? How much should they be worried about new competitors which are coming into this space? And a lot new interesting things. But before we move on, as always, I will just give you a fast overview of my portfolio, because as you can see here, cash position is same as in my last video, which means that I didn't do any buyings or sellings. But unfortunately, my chart, which is comparing my performance and S&P 500, is still not working. So I had to manually pull out my year-to-date return, and as you can see here, it is right now sitting above 5% for 2021, which is of course extremely good. I'm outperforming S&P 500, I am 5% up, and very nice beginning of the year. Let's move on to Netflix. As you can see here, they added 8.5 million new subscribers in Q4, and they crossed 200 million paid memberships mark, which is really unbelievable. Because of that, stock is right now up more than 10%, because nobody expected them to be able to add more than 8 million additional memberships in only 3 months in fourth quarter of last year. Why is that? Well, a lot of people expected that basically after all the lockdowns which we had in first half of this year, they have drained potential pool of new memberships, because whoever wanted to subscribe to Netflix, they subscribed while they were in the lockdown, because you had to stay home basically and you couldn't go anywhere. And that was perfect scenario and perfect environment for Netflix. And indeed they had added a lot, and I really mean a lot of new subscribers in first half of this year. So a lot of people expected that in the second half of this year, numbers will be really weak. That is why after they have disclosed that they have added more than 8 million of new memberships, stock is right now skyrocketing. So really kudos to them for being able to do such a good job on increasing new memberships. They already performed extremely well in the first half of 2020. If we turn to revenue growth year on year, you can see that growth rate is declining, not by a huge amount, but it is steadily declining, which is of course normal thing to see, because when a company is growing, it's harder and harder to keep growth rates at the same level. But their revenue is still growing for more than 20% annually, which is an incredible number. Bear in mind they are right now generating more than $22 billion annually, so to grow 20% annually on those numbers is extremely good results. When we come to operating income, you can see that they are also improving operating margins. 1 year ago they were standing below 10%, and right now they're 14%. They were more than 22% in second quarter and above 20% in third quarter, but we will speak more about that a little bit later. That is extremely important and interesting story. Why do they have such a different operating margins in different quarters? And if you check net cash provided by operating activities and free cash flow, you can see here that basically they are still more or less losing money. And again, you can see huge fluctuations from quarter to quarter, and we will focus more on this soon, because this is basically the most important part which you have to monitor, by my personal opinion. You can see here that free cash flow for the quarter was minus 284 million versus minus 1.7 billion in fourth quarter of 2019, which is of course huge improvement. But bear in mind they are still losing money, but nonetheless they are significantly improving their operating margins, and in 2021 they are currently anticipating free cash flow which will be around break even. Perhaps for most companies this isn't something groundbreaking, but for a Netflix which was losing billions and billions of dollars annually in last several years, this is great breakthrough and great foundation for their future growth. Again, they tend to continue to grow operating margins each year, but then look what they say here. Some years will be a little over, like in 2020, some years a little under, like in 2021. So let's focus on their operating margins and their free cash flow. Why was it so volatile, and why are they saying that some years they will be a little over their forecasts of free cash flow, like in 2020, and some years will be a little under, like in 2021? When we had hard lockdowns all over the world in March, they basically stopped filming their new series and movies. And of course, since they were not spending money, their free cash flow skyrocket, because when you cannot spend money and you keep generating huge amount of revenue, your operating margins and free cash flows start to skyrocket. Of course, you cannot be in that situation forever because sooner or later you have to spend additional money on new content. And that is why you have seen in fourth quarter, once they started, let's say, doing their business as usual or spending similar amounts of money that they usually spend, you have seen that they have started losing money again. They were free cash flow negative and their operating margins plummeted from basically about 20% to just 14%. So we have to track closely in the future how is their free cash flow going to look like and how are their operating margins going to look like. I had to pick one metric. That is what I would be looking for in next several quarters. Because 2020 wasn't usual year. Yes, they generated big amounts of free cash flow, but then yet again, it was because of shutdowns and because they had to pause filming new series and TV shows and movies. And I don't like them saying in some years we will be a little above and in some years we will be a little under free cash flow guidances. Because 2020 wasn't something that they have anticipated in terms of free cash flow. It was one-time event which will not repeat. Again, they had forecasted that in first quarter of 2021 they will add additional 6 million of new subscribers. You can see on this chart that basically in terms of adding new subscribers, it will be one of the weakest years since 2017, which is again something we could have anticipated because of a huge number of memberships and subscribers which they already have, and it's really hard to grow for tens and tens of millions annually new members when you already captured basically whole world. But sector for streaming services is growing, so I don't think that Netflix will saturate market anytime soon. Overall, I think they had great quarter. They really delivered on revenue, operating margins, growth in new members, and I really liked it. But let's now move on to competitors. How worried should investors in Netflix be? What I like to see is that they are openly talking about it. You can see that they are mentioning YouTube, TikTok, Instagram, and then competitors from Discovery, Disney+, CBS, Apple TV, Warner Media, HBO, NBC, etc., etc. So they are aware of their competitors, they are speaking openly about it, and that is what I like. I like transparency. On top of that, you can see that unbelievable number. Netflix is going to release one new original movie every week in 2021. So the amount of content which Netflix is putting out is not seen at any other streaming service. So the amount of money they are investing and the amount of new TV shows and movies that they are releasing is unprecedented. And that is why Netflix is the biggest and the most powerful streaming service in the world right now. You can see it here, Google search in 2020. Out of 10 TV shows which were most Googled, 9 came from Netflix, and out of 10 movies, 2 came from Netflix. They are dominating, they are the biggest, they are the strongest. Wherever and however you look at, Netflix is always number one. Another interesting thing why they are staying ahead of their competitors, which I haven't seen at any other streaming company, we continue to ramp up our local original content slate. So they are producing TV shows on German language, Korean language, Mexican language, Japanese. As you can see here, they are basically rolling out TV shows on local language for their biggest markets outside US. Again, there isn't any other streaming services which can compete with this. And that is why, again, I'm quite confident Netflix will stay leader in the world in this sector for years to come. But then again, we shouldn't ignore companies like Hulu, Disney+, HBO, etc. But there is another thing why I'm not so worried about them. Look at here. More than 80% of Amazon Prime subscribers, HBO subscribers, Peacock, Disney+, and Hulu subscribers are also subscribed to Netflix. So streaming service is not like cell phone company or car company, because if you buy one car or one cell phone, that's it. If, for example, Samsung is increasing its market share in cell phones, that means that Apple will have to drop. If GM is increasing, Ford will have to drop, right? Because nobody needs 2, 3, or 5 mobile phones or cars. But for streaming services, it is kind of a different story, because most of the subscribers are actually subscribed to more streaming services, and they are not exclusively subscribed to only one of them. So if there will be several streaming services which will be able to produce best possible content and with extremely high quality TV shows and movies, I am quite confident that consumers will be able to notice that and that consumer will simply subscribe to several streaming companies. So that is another reason why I am not so much afraid of their competitors. And here you can see how much does it cost to fight in the streaming wars, who is at the top. Netflix. Netflix spent basically more than second and third company together. So that is why Netflix will stay at top. Again, they have a lot of competitions, but they have also some structural advantages. Then we are coming to end of this video where I will let you know what is basically one thing which I dislike at this company and what is my opinion about price of a stock. Why I am not right now invested in Netflix company. The thing I am closely looking whenever Netflix comes out with a new report is this: long-term debt. As I've already stated at the beginning of this video, Netflix is free cash flow negative company. They were losing billions and billions of dollars in last several years annually. And if they're losing money every single year, they are of course consequently issuing new shares and, even more importantly, issuing long-term debt. And right now they have more than $15 billion of debt, which isn't something that you should ignore, but it also isn't something that is unseen in corporate world. I think $15 billion for a company of this size isn't something that you should be feared of, but again, this company isn't cheap, it's quite expensive, and this is something I do not like. Of course, you shouldn't watch past performance and history. You are investing in stocks because of the future of a company, and future of a Netflix is really, really bright. I am aware of that, and you should do that. But again, you shouldn't ignore that they are still losing money and they are still increasing their debt pile. Right now, debt is really, really cheap, but who knows what will happen next year or in 2024 or 2027. Probably Netflix in those years will start generating some amount of cash annually, but will it be enough to pay down the debt? Or for example, if interest rates on their debt goes up, perhaps they will eat that free cash flow which Netflix could have perhaps generated. So keep that in mind. Then we are coming to a price of Netflix. Of course, you cannot decide if company is cheap or expensive based only on PE ratio. But if you had to look at one number, that is the one you should keep your eye on. And trailing PE of Netflix is about 80 and forward PE is almost 60. You can see how fast it is declining, which means that their operating margins and their net income is growing rapidly. So everybody has to decide for itself is Netflix is good fit, is this is expensive or cheap. For me personally, and I am value investor, this is expensive, and that is why I am staying aside. But yet again, I was watching Netflix and staying aside since it was $50 or $60. So I have actually missed quite a lot of gains on this stock for not being invested. But just bear in mind, they have a lot of debt. Their PE ratio is extremely high, even for a tech company. I know you are watching future and you're not buying company for its past results, but there are a lot of perfect things that Netflix is going to achieve in the future priced into this really, really high valuation.